Welcome back to my YouTube channel. Today we discuss financial intermediaries. The flow of funds from savers to investors in real assets can be direct. If there are financial intermediaries in an economy, the flow can also be indirect. Financial intermediaries consist of financial institutions such as commercial banks, saving institutions, insurance companies, pensions funds, finance companies, and the mutual funds. The intermediaries come between ultimate borrowers and the lenders by transforming direct claims into the indirect claim. Financial intermediaries purchase direct or primary security and in turn issue their own indirect or secondary security to the public. For example, the direct security that a saving and the loan association purchases is a mortgage. The direct claim issued is a saving amount or a certificate of deposit. A life insurance company, on the other hand, purchases corporate bonds, among other things, and issues life insurance policies. Financial intermediation is the process of savers depositing funds with financial intermediaries rather than directly buying stocks and bonds and letting the intermediaries do the lending to the ultimate investors. We usually think of financial intermediate making the market more efficient by lowering the cost and or inconvenience to consumer of financial services. Among the various financial intermediaries, some institutions invest much more heavily in the securities of business firms than others. In what follows, we concentrate on those institutions involved in buying and selling corporate securities. Deposit institutions. Commercial banks are the most important source of the funds for business firms in the aggregate. Banks acquire demand, checking, and time-saving deposits from the individuals, companies, and government and in turn make loans and investment. Among the loans made to business firms are seasonal and other short-term loans, intermediate term loans of up to 5 years, and mortgage loans. Besides performing a banking function, commercial banks affect business firms through their trust department, which invest in corporate bonds and stocks. They also make mortgage loans available to companies and manage funds. Other deposit institutions include saving and the loan associations, mutual saving banks, and the credit unions. These institutions are primarily involved with individuals acquiring their saving and making home and consumer loans. Insurance companies. These are two types of insurance companies: property and the casualty companies, and life insurance companies. These are in the business of collecting periodic payment from those they insure in exchange for providing payouts should event usually adverse occur. With the funds received in premium payments, insurance companies build reserves. These reserves and a portion of the insurance company's capital are invested in the financial assets. Property and the casualty companies insure against fires, thefts, car accidents, and similar unpleasant incidents. Because these companies pay tax at the full corporate income tax rate, they invest heavily in municipal bonds which offer tax-exempt interest income. To a lesser extent, they also invest in corporate stocks and bonds. Life insurance companies insure against the loss of life because the mortality of a large group of individuals is highly predictable. These companies are able to invest in long-term securities. Also, the income of these institutions is partially exempt from the taxes owing to the buildup of the reserves over time. They therefore seek taxable investment with yields higher than those of tax-exempt municipal bonds. As a result, life insurance companies invest heavily in corporate bonds. Also important are mortgages, some of which are granted to business firms.